But first, the U.S. Federal Reserve Chair Janet Yellen says the economy is showing signs of gradually improving, and that may lead to the strong possibility of the first interest rate hike in nearly a decade. Some say it could happen later this year. Daniel Wrenches was at the meeting, and he's here with much more. What's going on?
Well, Phil, as you were saying, it looks like we've still got an interest rate rise on the cards this year, despite the fact that the International Monetary Fund urged Janet Yellen earlier not to do it. The Federal Reserve Chair's message to her is don't get caught up in the timing. Back in the hot seat, the chair of the Federal Reserve brushed off the advice she recently received publicly from the head of the International Monetary Fund, Christine Lagarde, to hold off on increasing the benchmark interest rate until 2016.
Clearly, most participants are anticipating that a rate increase this year will be appropriate. Now, that assumes, as you can see, that they're expecting a pickup in growth in the second half of this year.
For now, the officials are keeping the federal funds rate at a range between 0 to 0.25%. Keeping it low generally leads to low borrowing costs for loans and mortgages, but the main risk is stoking inflation. But so far, inflation numbers have been very low, influenced by dipping energy costs and the high price of the US dollar on global currency markets, which has the effect of lowering the costs of US imports. Janet Yellen says that people shouldn't be obsessed about the timing of the first rate hike.
Sometimes too much attention is placed on the timing of the first increase in the federal funds rate. And what should matter to market participants is the entire trajectory.
In other words, so what if there's a rate hike this year? Why don't we all focus on the fact that the ramp up in interest rates is predicted to be very gradual? Because the economy hasn't completely shaken off the ravages of the financial crisis, and the Fed doesn't want to upset the recovery. But as ever, Yellen's back to her often repeated mantra that whatever move the Fed makes will come as the result of incoming data. Better than expected may speed things up. Worse than expected, Phil, slow things down.
You seem a little excited about this whole Fed thing. And for our viewers, you don't know this, but you were actually at that meeting. We just saw some video there. You were at the meeting. A lot of reporters asked questions. What was the mood like there?
Well, I think that it's safe to say that Janet Yellen now is a firmly established authority. And, you know, what they were doing is the same thing that people do when they're on the conference calls for year-long results. They sort of say, go on, tell us what's going to happen. Please tell us what's going to happen. Every single question is pretty much the same. You know what her answer is. Depends on the data. So she stays pretty steady. She gets a few questions that might be thrown in that are a bit, you know, might try to trip her up a bit, but she's very solid. One thing I would say is just a little tidbit. She did give one tidbit, and that was that what she said basically, watch productivity. If US productivity starts to go up, then she thinks that's going to start to filter through to wage growth, proper wage growth. That would then be a sign that the US economy is starting to cook.
Now, the other thing that I've been reading is expectation is a rate hike at the end of this year and maybe one next year. Did you get the sense that that was basically it, or was Janet leaving the door open, perhaps, that there could be more down the road?
Right, so probably you're going to get, now we're at 0 to 0.25% interest rates. We're probably going to get maybe September, 0.25 to 0.5 range. Okay, so it's still really low. And then maybe early next year, they'll start to think about the second one, bringing up from 0.5 to 0.75%. So Janet Yellen's saying, look, you may think that this is going to have a dramatic effect, and certainly what we're going to try and do is telegraph to the rest of the world when this happens based on the data. But don't get in a panic. Don't get too wound up by one data rise, because over the course of the next couple of years, we are not even going to be in the proper range, the normal range of what we expect in 2 years' time. So don't get wound up. We are not going to put the brakes on this economy too quickly.
In other words, don't jump the gun and just don't panic.
Yeah.
Just take it easy. Daniel, excellent to have you in that room. And for everybody, some insights you're not going to hear anywhere else.